I haven't looked yet today because we won't get that information until tomorrow or the next day. But open interest as of Friday was still at just under 59,000 contracts. I think it was 58,770 contracts. And each contract is 5,000 ounces of silver, so that's 294 million ounces of silver still open in March, meaning that they could stand for delivery. Now, normally arbitrage, it ends quickly because all the money flows to where the arbitrage.
Totally.
Well, they're not letting it in. They're keeping the premium there to entice this continual sucking of metal out of the West. If you listen closely, you hear that sucking sound. The attempt by the CME group to massively raise margins in many ways has distorted this market. Countries and entities in a world that has lost trust in the West, where we have weaponized sanctions and tariffs that are actually sanctions pretending to be tariffs, all of these things, no one trusts us anymore. And they don't trust the dollar or our fiscal restraint. And the US dollar is slipping, and it's a top risk this year. And he cites that the dollar share of global forex reserves has fallen to just about 55% from 70 in years past, and the dollar's drop is to the benefit of gold, the euro, and the yuan as they are rising. And he cites it as a direct signal that the markets are diversifying away from the dollar. He also went on to say that Fed rate cuts are not optional, that they're a key tool to steady markets and confidence. And look, this is a situation where, the dollar system is based on confidence, Jared, and the confidence is gone in many ways. And so on one hand, you look at what China is doing. They just told their large banks to stop loading up on U.S. treasuries, in fact, to trim exposure on them. They are starting to treat U.S. government debt or our bonds like it's a concentration risk, not the ultimate safe haven that we've always been told. And they're speeding up their exit from the dollar and de-risking the dollar system. I think that's something from a primary standpoint that people need to understand. When you talk about, what's going on with the silver market, yeah, we knew that this was going to happen. I'll get to that in 1 second. I wanted to talk about also David Einhorn, the billionaire who thinks gold is already on its way to becoming the world's ultimate reserve asset, that it's starting to replace the treasuries. You're getting guys like Ray Dalio and now David Einhorn saying these things out loud. He cites the central bank buying, as we've talked about forever, and that almost 80% of reserve managers see that gold will be a higher share of reserves 5 years from now. So the macro side of things still looks very good. And when you talk about what's going on with silver, they had to try and do this. We're 10 days away, Jared, from first notice day on the March silver contract. And people need to understand what this means. I haven't looked yet today because we won't get that information until tomorrow or the next day. But open interest as of Friday was still at just under 59,000 contracts. I think it was 58,770 contracts. And each contract is 5,000 ounces of silver, so that's 294 million ounces of silver still open in March, meaning that they could stand for delivery. Now, normally arbitrage, it ends quickly because all the money flows to where the arbitrage is.
Totally.
Well, they're not letting it in. They're keeping the premium there to entice this continual sucking of metal out of the West. If you listen closely, you hear that sucking sound. Not only are they going to pay that premium, but they're paying a premium and the VAT tax ultimately. So goes to show what they really think about the price of gold and silver, that its value is far more than the paper currency that is being used to buy it. And that's exactly what you're seeing in that. So at the same time, this is why you see backwardation, because it's like the forwards and the futures are starting to feel to many as maybe undeliverable, or the risk is not worth that extra vig out in the future. So normally markets work in contango, where the further out you go, the higher the price you pay because of the cost of storage, the cost of insurance, the time value of money, interest and stuff. But now they're saying, you know what, I don't, these forwards are too nerve-wracking to me. And I wonder if there's going to be a problem or a default, a force majeure, an undeliverability. So markets, you can't source that metal. You can't hedge easily right now. And, you know, I just think that what you are seeing is a situation where there is what started out as a tiptoe and then a little walk and then maybe a jaunt and maybe just a little trot, all of a sudden turns into a sprint and an all-out, you know, bust ass to get as much as you can. We're not there yet. A lot of people say, well, why didn't the Chinese or the Russians or the Saudis, why don't they just spend all that extra money they have and buy everything? Because just like that, you cut off your nose to spite your face. Instead, as the title of my podcast is, little by little, little by little by little by little by little, they continue to chip away at the available stock supply of metal all around the globe, and have done so quite successfully, to where it's now becoming realization. And I think the realization is evidenced by whoever in the United States said, this is happening, we need to stand for delivery. And I don't mean to keep harping on it, because I do a lot, but to me, it's all that really matters, Jared. At that rate, these people do not fuck around at that level. When they're spending billions upon billions every month, every single month, billions and billions and billions and billions. And not only do these people not fuck around, why is there not a word by the mainstream as to who it is or that it's even happening? You see, they catch on to the fact that gold and silver have gone higher, and that's their journalistic integrity. They're full of crap is what they are, because they haven't looked underneath the hood. It's not that the price of gold and silver have outperformed and have gone up higher. It's that who's standing for delivery to amounts that far exceed anything what the world has ever seen here in the United States, on a habitual, continual 16-month-in-a-row basis. When that question gets answered or even asked, then I'll feel a little bit maybe less convicted that we are a long ways away from where this ultimately ends up, because the big money is using this cover of drive-by shooting, of raising of margins, of price that is very volatile and frightening, to run cover for standing for delivery for massive amounts. And they are more than happy to knock it down and take delivery at subsidized prices. At the same time, knock out all the levered longs who are on margin, who aren't able to continue to post margin in this environment. This is classic shake the hell out of the bushes. And it can't go on forever, because the stockpiles of availability are at record lows or fast approaching it. And at some point, paper promises that are no longer trusted when there's nothing standing behind it, well, that's a problem, right? And that's where we're at, and it's starting to accelerate. So that walk, that fast-paced walk, could very quickly turn into a jog, a sprint, and an all-out, get it now. We're not quite there, but you can feel it accelerating if you take a step back and look at it for what it is. The attempt by the CME group to massively raise margins in many ways has distorted this market, because it's put so much pressure on the refiners, who are all shut down. Because if the refiners are taking in metal that need to be broken down in various forms, whether it be, like flatware or knives and forks and stuff that are silver, like sterling, a knife, the blade is stainless steel. The handle is plaster. It's a little coating of sterling silver over the handle. The amount of effort it takes to snap off the blade, pull off the sterling off the handle, throw that stuff away, put it in a bin, and continue to do that with all your other stuff, then melt it down into shot, and then from shot, melt it into bars. This takes a lot of time. Well, the refiners, with the continual increase in margin costs and the rising price of silver, for the last few months, has shut down every refinery, because they're getting margin called. If they have 50 million in inventory that they've paid the public, they have to hedge 50 million. In other words, they sell short. And so they're market neutral, but it takes so much time to process what they're refining that they're not even breaking it down or melting it down yet before they're margin called. And so it shut down a massive source of liquidity. The small dealers, like your local coin shops who don't hedge, if they take in 100 grand of silver eagles and the price of silver falls by $8, like we've seen these big moves, up 8, down 8, which we never would have dreamed of, right? I remember telling Kevin, who works for me, that you will see days of multiple dollar increases. And he's like, well, it never moves up more than $1. Well, true. Now we are. And I think we'll see that even to a much greater extent as real price discovery comes into play. But these refiners were margin called, shut down, and the small companies, small dealers who don't hedge, if you buy it and pay spot and it falls by $8 on 100,000 worth of silver and 1,000 ounces, you're down $8,000. You're not going to get that back. You make a fraction of that when you sell silver. And so the point of it is that the small dealers who don't hedge have to be way back a spot. The dealers that are hedging, a week or two before Christmas, if we typically have 2 million ounces of silver in a warehouse, and we hedge it with futures contracts, a few weeks before Christmas, it was about $16,000, $17,000 to hedge 5,000 ounces to buy a contract. One futures contract, 5,000 ounces. Now it's almost 50,000. The cost has gone up so much that even the big companies like ourselves, if you don't have 50 million bucks in your margin account, you're not holding a big inventory. And that's just silver. What about gold and platinum? You have to hedge it. Well, the prices continue to go higher on the margin account, which has forced all the speculators out of COMEX, but it's really did a number on this industry for right now, where premiums are very disconnected. They're high buy prices and low bid prices. I've never seen this in 36 years. Never, ever, nothing like it. As who wants your debt when you're lowering rates synthetically and forcing them down? Who wants your debt when you have shown zero fiscal restraint, zero, and continue to, with reckless abandon and fiscal irresponsibility, print money like it's going out of style? It's very interesting. We had and you're right. I mean, but this is the really the crux of the issue, right? Who's going to finance all of this stuff? Which is a problem that we will continue, I think, to have. And when you look at, like, for example, they bring in Doge, which really didn't do much. But one of the things that Doge did usher in is in 2025, the federal workforce was cut by 270,000 people in under a year. That was the largest peacetime reduction on record per the Cato Institute. And yet spending still rose. They spent $7 trillion in fiscal year 2025, $300 billion more than the year before, which is, the bottom line is it tells you that we could fire. If you look at right now, the federal payroll is about $336 billion. It's 5% of the budget. You could fire every single person in Washington, and you'd still have, get rid of every bureaucrat, and 95% of the spending keeps on rolling because it's Medicare and Medicaid and Social Security and government military pensions, and we are broke. We're broke and we're insolvent. And so the question becomes, well, who's going to buy the bonds? And how do you finance, like, for example, your failing and your old in disrepair electrical grid, when China is every year is spending more money on grids than we do on our entire global grid. I mean, the United States, every year they're building more and more and more so that they can be the leaders in manufacturing and AI and technology and all of that stuff. And we're not. Instead we're spending money on, if you look at what we spent money on the previous administration, billions and billions and billions on, on helping transgender people stop smoking in Pakistan. I mean, weird crap like that, right? We're so far astray from fixing the problems, and now we're trying to get serious about it. But how? How do you lower rates and entice people to buy our debt when we're creating $1 trillion in debt every 100 days with zero fiscal restraint? I don't think you do. And so this becomes a problem. This is where the Genius Act comes into play. These are the things that are happening. And this is why, really, this is a system that's all about trust. Who trusts us anymore? People say, well, who trusts China? Well, China is trying to do things where they're using the redeemability of the digital yuan into gold. And so the trust is you can validate and verify the trust if your currency is in essence convertible into gold. And that is what they are doing in China on the highest of levels in trading their digital yuan. But They're also expanding their interest or their influence all through Africa in selling bonds at a lower rate than the West is. So there's lower costs involved for these emerging nations, but then all of the funding of the Belt Road that these countries in Africa are borrowing in yuan, everything that they're doing is in yuan. So that chips away at the dollar settlement status, it chips away at the dollar reserve status. There's fewer and fewer and fewer countries and entities in a world that has lost trust in the West, where we have weaponized and sanctions and tariffs that are actually sanctions pretending to be tariffs. All of these things, no one trusts us anymore. And they don't trust the dollar or our fiscal restraint. My son, who works for Miles Franklin now, was an accountant at Price Waterhouse, analyzing a real estate investment trust balance sheet every year. And that he had a client that was a real estate investment trust and a REIT. Well, what do you need to pay this kid $80,000 for and have him occupy a cubicle in an office in Manhattan when AI does it on a server in 10 seconds for free and probably is more thorough? You don't. And so not only do you have the new phenomenon of people working from home and maybe being just as or maybe even more productive, you also have now AI, which will kneecap a lot of jobs. So these companies that have big exposure to commercial real estate, what does it mean when it comes time to renew said lease? I think it's very frightening. And who is responsible for the majority, not only of the small business loans, but of the majority of all of the real estate loans and leases? It is the regional banks. They're the ones on the hook for the majority of it. It's the sophistication of shorting and hedging your position. You got to know what you're doing, you get crushed. And so if you don't hedge and the volatility of the market is such, if you're not moving stuff on a continual basis, you're in a rising market that doesn't have this kind of volatility. You don't need to hedge if you have enough of a bankroll to handle the volatility. But in a market that we see right now, if you're not hedging, you're out of your flipping mind. But the cost of hedging is enormous for companies like mine or even the very, very large primary distributors. They must have a couple $100 million in their margin account just to protect their inventory, the big primary distributors. And small companies aren't doing that. So if you take in metal and the price is that volatile, what happens if it goes against you? What if you buy $1 million worth of metal for someone and the minute they walk out the door, before they even leave, the price drops by $4 an ounce, $5 an ounce on what? 10,000 ounces of silver, whatever the number may be, or 20,000 ounces of silver, 30,000, you're dead. You're dead. What are you going to do? You'll never make that money back. And so they have to bid way back of spot. For those that do hedge, like I said, it was about $15,000 a week or two before Christmas to hedge 5,000 ounces. Now it's almost 50,000 to hedge 5,000 ounces. And if you have 2 or 3 million ounces in your warehouse, as we normally do, what are you going to do? You're going to just risk it or are you going to hedge it? You just have to have that money in a margin account. Well, that doesn't even take into account the gold and the platinum and all the other stuff, the insurance, the cost of, and this was done by the CME group to knock out speculators on COMEX. It's really done a number on this industry. We'll buy all of it back. But it's interesting with junk silver. Now, I've never would have expected this in my entire career. This goes to show that we are in a period of time where weirdness happens everywhere. Go back to 2020. It's been weird ever since. And, during the pandemic, for 4 years, nothing performed better than junk silver other than Silver Eagles. Nothing. Would have paid you $9, $10 over spot for as much as you would sell us. Now you're getting back a spot. And that is because, the refiners are all shut down because they can't hedge because they're getting margin called and they're backed up. The small dealers are freaked out because of the volatility if they don't hedge, and the big dealers will buy it. But because of the cost of hedging and because I can buy it elsewhere for less, the bids are awful. That will change. These are anomalies in price. And if someone said to me, I got unlimited time frame, I want the best value, you buy pre-65 silver at spot or below spot. I've never seen that in 36 years where you can, get as much as you want at spot or below. and on a retail level, never. And so, yeah, I mean, will we see things go back to normal? I believe very much so we will. But you look at anyone who's really, really been successful in investing, you do things when they're out of favor. I mean, look at David Bateman. People would have said, you're out of your fucking mind, David, to put that much money into silver. And he beat everybody, right? So the point of it is that that's how success is accomplished, by buying low and selling high, buying when there's blood in the streets. Interview Rick Rule, he's a good buddy of mine. He'll tell you the most money he ever made is when buying things when people said he was crazy. And, you know, you have to buy things when they're out of favor if you really want outsized potential. Well, I will tell you, in 36 years, I've never seen junk silver like this, ever. And when the refiners get back to, run back to speed, look, at very most, you're going to get, if you bring it to a refiner, the least you should get is 99% of melt value, because they have to melt it down, so they get 1%. But that's the very least, and normally it's much higher in that, like during the pandemic, where $9, $10 over spot we were paying. So you want to take a risk on huge upside potential. Junk silver, in my mind, which is the best value, I've never seen it like this. That to me is kind of the weirdness of the market right now.